yes, we wanted to get out of our day jobs, and we wanted to be able to own our own destiny. And the way that we saw, the path we saw to get there was to create this passive income stream, this note portfolio.
Do a few flips a month that were larger and that were all cash flips. That's a lumpy business, whereas the note portfolio, like, it would smooth out those lumps.
Yeah, there's lessons.
I can see the pain in your eyes.
Man, lots of lessons here.
What's up, man? How are you?
Good, man. How you doing?
Doing good. You want to go through some painful memories?
Yeah, why not? I mean, it's been a journey.
Cool. So I thought what we could do today is talk about the road to $1 million.
Our first million in land.
First million.
Yeah. Holy that. Wow. We are going to go through some trauma here.
Took a while. Took a lot longer than I think we were expecting.
It did. It definitely did. Especially both coming from other spaces in real estate and seeing bigger deals. Yeah. A lot more time than I think we both anticipated.
For sure. So, well, I mean,
but it didn't have to be. It didn't have to take that long.
Yeah, we are masochist, so we made it painful for ourselves because we had to do things our way, I guess. We could have followed probably a better roadmap.
Yeah, we could have sought out some other advice. Maybe if we had heard a podcast like this, we might have learned a thing or two.
Shameless self-plug. I like it. I mean, I don't even really know when we made our first million. I will say that, like, going through the startup process, bookkeeping was haywire, and you're kind of trying to decipher like what's real versus what's not. So is it like, hey, did you sell $1 million in real estate? Did you, like, that sounds cool, but it's not that cool. Or is it like, did you build a note portfolio that's worth $1 million? Or did you actually get like $1 million of cash in your bank account? What was it made up of? Was it some of the cash that you invested and now the cash is there plus some profit, hopefully? Or was it like actually $1 million of profit? So it's kind of like hard to decipher, and going back all the way from when we started in 2014 to, I'm guessing, it took us a few years to really get to like our first true million, right?
Yeah. I mean, you bring up a good point. I think that's evident everywhere in real estate. You have all these vanity metrics, right? Where the first thing that you said, what's the first, you just sold $1 million in real estate. And it's like, oh, well, was that one expensive house, or, was that 1,000 deals? There's a lot of context that needs to go behind that to really give it the weight that it deserves. So yeah, what should we focus on? That, because I think I've got my answer, right? But what do you think?
I mean, I think we talk about what's important. New land investors that are just getting into the business, like, where are they starting and what's meaningful to them? Because everybody has a different thing that they're going for. Some people are going for cash and they want to quit their job that they hate and they don't want to go back in and see their manager that's yelling at them. And other people, they might be starting the land business with a whole big bankroll, and it's a different game for them. They're trying to generate more passive style income that's maybe a higher return on paper, but maybe not as much dollars in the door. So I think we kind of dive into that.
Yeah, I agree. Let's roll, man. So where do you want to start?
Well, in our world where we did it, we were all about buying for cash and then selling on terms. And so, if we go back to that era, it was kind of like buy for $1,000 and sell for $4,000, and to collect a payment of, I don't know, $100, $200 as a down payment, and then maybe make 100 to 150 bucks a month or something like that. But we could just call it 99 down, 99 a month. And I remember you and I were going back and forth a lot because we were really working out the math, because we had jobs at the time. Like, we had, I was flying planes and you were doing the development thing. And so we had the income coming in from our day jobs. So it wasn't like as pressing, right, to really make the business profitable back then, because we didn't need to use it to pay the bills, other than just keeping the land land business lights on, right? But the distinct thing that I remember is after we had done several deals, we would calculate it out to find out when did we get our payback? Like when did we actually get the money that we invested back? And it always kind of landed around, it would average around 18 months.
Yeah, yeah. I remember the range being anywhere from like 12 to 18 months typically, for the deals. And that was a lot of factors went into that, right? As far as a processing fee, or as far as what the monthly payment was that we set for the properties, or the pricing, the tier, the value of the property itself. But yeah, it was about 12 to 18 months. So, and I mean, in context too, to add to what you were saying, I think we kind of took the approach where, yes, we wanted to get out of our day jobs, and we wanted to be able to kind of own our own destiny. And the way that we saw, the path we saw to get there, was to create this passive income stream, this note portfolio. And so you know, we both read Rich Dad Poor Dad and gone through all of that, and uh, we knew that we just needed to do volume and build up this note portfolio, and then that money would just be coming in like clockwork, right? And it was not truly passive, as we learned also along the way, but definitely having that residual coming in every month. That was our goal, right? And we had set clear targets, like what do we need to do? We need to replace our current income. And then as we started to do some deals, we'd go back and we'd look and we'd say, okay, now we've been able to generate this much revenue, but then now we need to have additional capital to go out and buy more properties. And so we had to factor in all these different things to consider, as far as how quickly we could get to that place where we had truly replaced our income from our day jobs.
Right. Yeah. And I mean, I think one of the things that we learned back then was we were so focused on the ROI on paper, but not the actual dollars coming through the door. We were just not willing to sell a property for what we thought was like a wholesale price, right? If we wanted to get that $4,000 on a property, we cared more about selling it on a seller financed note rather than taking $3,000 cash, that would have been realized right away, $2,000 profit. Maybe the ROI wouldn't be as sexy on paper, back to the vanity metric thing, but like we would have money way quicker that we could then cycle and turn over, right?
Yeah. Yeah. There's lessons.
I can see the pain in your eyes. I mean, we lived this story for too long. We were like not willing to sacrifice the sale price for getting the money in the door, cash sales. So I think, if we're going to kind of break this down into some lessons learned from a hard past, I feel like that's number one is take stock of where are you when you're starting the business. So if we were to just drop in maybe two buckets, bucket number one is you don't have any money and you're working a day job and you want to get out of that day job, then that's sort of your starting point there. Whereas the other bucket is you have a lot of money and you don't need it right away. And of course there's all sorts of things like along the spectrum in the middle. But if you're there and you're in that position where you do not have money and you want to get out of your day job, then skew the business more towards cash sales. Like take the lower sale price but get the cash in the door, because you're gonna churn the capital, which really, I mean, we've discovered is it's a better way anyway to use capital. You just turn it over and over and over quickly. But if you're in that other portion where you're in that other bucket where you have a bunch of money, you may focus a little bit more on what we're calling passive income, but it's repeatable revenue. You're bringing in repeatable revenue, and that's really nice too because it gives you safety. Like that's one thing that I know as we built a big note portfolio and then we let go of we sold our whole portfolio once, and then we didn't really have much. We had maybe 100 notes left over in our portfolio, but we sold off a huge chunk of what we had going, and then we built it back up, and then we sold chunks of it too. The As we would sell it down, we didn't have like as much security. we always had to, because we were trying to do bigger flips and, do a few flips a month that were larger and that were all cash flips, that that's a lumpy business. Whereas the note portfolio, like it would smooth out those lumps. So having both is sort of like the best way. But as you're starting, I would tell people like, look, go 80/20. Like do focus 80% of your sales if you're just starting out and you need the money. Just do the cash flips, like take the lower price, do the cash flip, feed yourself, grow the business. And then as you want more stability, then, start to skew it the other way. Like do skew it more towards 80% of, seller finance down the road. You know what I mean?
Yeah, totally. I think, we were a little blinded by the ROI, as you mentioned, and looking at that as kind of that vanity metric where we're sitting there, we're like, well, we're getting 400, 500+% returns. And that's amazing. But then we totally neglected the IRR principle, right? And it is, they're two different philosophies, two different approaches. And I think they're both really important, and you can have a philosophy that skews one way or the other. But I do think it is important, like you said, to evaluate where you are at that point in time to see what's going to help you get to that goal, that next level of where you want to be. I think the 80/20 is right on with what I wish we would have done, where, in just very simple terms, if we had the ability, we bought 4 properties and then we turned around and we sold 3 of them for cash, even if we were wholesaling them or if we were selling them cash for retail, maybe a little bit higher of a price point than what we would wholesale it for, but you're getting that cash back in the door. And then that allows you to buy another 4 properties almost instantly, as opposed to waiting that 12 to 18 months before you get that initial investment back without any other additional return, and then being able to redeploy that capital, right? So I think that is really sound advice. And again, I wish what we would have done, to just grow at a much faster scale and be able to do, you get a lot more experience, exposure, you get to see a lot more deal flow that way, but you also get you also get the ability to see other markets, see more deal flow, get more experience all around, and learn some of the markets that may perform really well for certain types of deals, right? So we found that was also kind of intriguing to me. It makes more sense now as we've evaluated it, but there are markets that are very conducive to cash flips, right? And there's a real solid buyer pool for being able to just quickly turn those properties. And then there are other markets that are very conducive to the term sales, the note sales, where you do the seller financing and you're able to command a higher price. You're able to still sell those properties at a good velocity, but they do not sell very well for cash. So being able to kind of feel those markets out, and then as you start to identify which markets perform better for each one, and you get that capital back in the coffers, then you can choose where to deploy it. And you can say, okay, I do need to replenish some capital, so I'm going to go deploy this capital over in this market or these few markets where I know that the focus is going to be some of those cash sales. Or now I've got some more cash in the bank, and now I want to build out some of that passive income coming in from the note portfolio. So I'm going to go in and I'm going to invest in these other markets, and I'm going to continue to build that up.
Yeah. Yeah, absolutely. We can talk about markets too and just how spread out you should get and when the right time is to expand. I know we've made a lot of mistakes there too. But the thing that you got me thinking about was just the balance sheet, right? If we were looking at our balance sheet got to be $1 million probably in the first couple of years, right?
Yeah,
I'm just
pretty
just
quick.
guessing because we had
Yeah.
the value of the properties that we had purchased and we had the cash in the bank, which was always very, very limited because we were constantly running on fumes trying to build this note portfolio. And then we actually had the value of the notes. And, looking at the balance sheet was kind of a joke because it was like, oh my gosh, like the balance sheet's $1 million. This is amazing. But we have no actual cash, coming in the door, right?
Yeah, we're rich on paper, but we don't got anything to show for it.
Yeah. So lessons learned. I mean, this is not a balance sheet business at all. I would never call it that. It is a, we are going to be looking at like a profit and loss and see what the actual profit is. And then we can feed ourselves. Otherwise you can't, you're just looking at pretty paper.
Yeah, exactly. Yeah, I think that's a big misconception. Um, just yeah, you couldn't have said it better. It's really not just exclusively a balance sheet business. I mean, of course, the balance sheet is an important metric to evaluate, but profit is where it's at. You're not going to be able to survive if you don't have cash, and you need to be able to have profit to be able to continue to grow. So,
Yeah,
or to
it's the
survive.
oxygen. Yeah, dude, it's
It's
the
the opposite.
oxygen for the business.
Yeah,
I forget who said that. There was someone that actually like came up with that, but but yeah, it is. It's really oxygen. Like cash flow is the oxygen for the business. So
yeah,
I think it was Dan Sullivan. But let's
yeah.
dive into markets. So markets and expansion. I mean, like that was one thing that I think we also probably bumped our nose on a little bit. It took us a while. We stayed, I think, in the same markets for a bit, but then there was a point where we got a little unwieldy and we just started going everywhere, you know?
Yeah, we
Like,
probably went from 5 markets to 20 markets in the span of 2 or 3 months. It was
yeah.
quick. Yeah.
Yeah.
And a
So
lot of
market.
pain associated with that, man.
Yeah, I'm trying to think of a way to describe it, but it's just like getting grinded down by learning a new market over and over and over again so quickly and developing the knowledge of valuations and what's important to that market and whether or not it's going to be moving fast or slow. Like that's a grind. But I think what we were doing at the time is we were just trying to acquire inventory using like going through auctions, right?
Yeah, mostly we had kind of started to jump into the auction space, and so we were kind of just jumping into any market that had an auction where we saw some opportunity, and then we were trying to figure it out as we went. Um, but I mean, to your point too, and we had Dan on the show, and he made a really good point with the compounding effects of how valuable it is to just know your market inside and out, right? And we got spread so thin so fast that we then had to allocate so many resources, so much time and effort to trying to learn those markets. And sure, we probably missed out on a fair amount of money by not knowing the pricing in the markets and underselling properties. We probably held properties for far too long because we had overpriced them. And again, our stubbornness of being willing to back off of what we thought the value really was, or maybe where we saw some comp and we didn't really understand how that market was acting, then we lost a fair amount. It took us a while to kind of get back to where we felt like we really knew what was going on. We had done several deals. We could get a pretty good gauge of what the velocity of that market would be, what types of deals that market had an appetite for, who the buyers were in that market, how to market to those buyers. I mean, so much goes into that. So I can't
Yeah.
stress the importance of knowing that market inside and out, right? We kind of embraced that philosophy of an inch wide and a mile deep. We just went so deep on markets. I mean, as we got to that point, we started to wholesale a bunch of inventory in these markets that we just didn't feel like we had a good grasp on, because we wanted to go back and just focus on the markets where we had success and continue to go deeper and continue to extract as many deals as we could out of those markets and really just establish the presence there.
Yeah, well, and I don't even think we realized that until like 7 or 8 years into the business, which is the funny
Exactly. Yeah. Way
thing.
too late.
There was, I mean, so couple other mistakes that are coming to mind right off that is like we kind of believed our own BS. We number one, we didn't want to settle for some price that we thought was below market value. We were like, no, like we're the ones that buy properties for below market value, but we don't sell them for below market value. We're not going to sell them above market value, most likely. That's fine. But like as long as we get market value, we're happy. But like we always talk about, the definition of market value is what someone's willing to pay for it at the time. So we would get offers, and if it was like a 3.9x, we would be like, nope, it's not a 4x on like what we bought it for. But like what we bought it for, it doesn't matter. No one cares. It's just what they're willing to pay. And I mean, tons of times we passed up on good money trying to knock down the door because it didn't meet whatever criteria that we had set out based on what we bought it for. I mean, it was like absolutely silly. So that's one thing that comes to mind. There's another thing that comes to mind too, is like we were trying to set the market in some of these places. You know, we had this theory that like we are the market because we're doing a lot of deals, and there's really not an MLS for these types of properties. So sure, there's other people doing some deals, but we're buying like so many, we're going to just try to set the market, right? And in some cases that actually worked. You know, like there was a few places that we struck some deals where we found a seller that owned a ton of properties. We created a bulk purchase agreement with them, a long-term takedown, and we had access to a bunch of inventory. And I mean, two specific areas that I can think of. And in those scenarios, like we actually did have the most inventory on the market. So we raised those prices and that worked. Everywhere else, it did not work. Like we would try to go in and sort of like set the market or set the bar. And like looking back, I would rather just undercut the market a little bit and move the property quicker. I don't know
Yeah,
how you feel about
yeah,
it.
totally, man. I think that it, again, going back to it took us way too long to figure this out, but velocity is probably one of the biggest factors I think that will dictate success, right? I mean, sure, you can buy a property and you can hold it forever and then you can sell it for a lot for a bigger return. But man, time value of money, didn't get it. You didn't get a great return on that, right? And it just took us too long to figure out, hey, let's push velocity. Let's let's respond to what the market is actually telling us. And we, you know, we made up a lot of excuses along the way where it was like, oh, you know, we haven't really fully launched our marketing in that market yet. So we haven't really reached the full audience, and we may not have gotten in front of that right person who's going to pay that extra money. And it's like, no, like we deployed some marketing, we got this response, that we're going to take that deal because that's in front of us, and then we're going to get that cash back and we're going to recycle it, and we're going to go back and we're going to try again and find another property, and then be able to expand our marketing, and maybe we do find another buyer that will pay more, and then we can recycle that again. Or maybe we got lucky with that first deal, and then we do need to continue to listen to the market and adjust down. And then we need to be more aggressive on our acquisitions so that we're not overpaying for the properties, right? So velocity, 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 man, there is another common saying in real estate, and it's the first offer that you get is often the best offer, right? And that was a really hard lesson for me to personally take, because you don't want to just give it all away just because somebody jumped on it and gave you a quick offer, right? But man, I mean, in the several thousand deals that we've done, it'd be really interesting to be able to go back and look and say, oh man, how many deals did we turn down? And then we ended up settling for a lower offer. And then, man, I don't even want to do the math on what that would translate to as far as a loss, right? If we were to evaluate like time value of money just on a standard return, oof.
Yeah, we're obviously not very good at doing math in the first place, so let's not go back and do that. Let alone on a podcast where people
Yeah.
can see how bad at math we really are. Um, so you know that though, like that makes me think about, you know, selling notes and you know, if you're trying to get your money back. One of the things that I think we did take away eventually was, and it probably wasn't really as big of a market for buying notes when we started as it is today. And there just wasn't as many avenues to go out and sell promissory notes. But at some point, you know, in the 2020, well, in 2020, we sold a huge chunk of our portfolio to one specific buyer. So that was probably like the most liquid that we've ever been. And that was an
Yeah.
interesting time. But then after that, we kind of realized, we were like, oh, you know what? There's actually a market for people that want to buy these notes. And like that was a cool lever to be able to pull, because we did have a balance sheet that was impressive, and we had notes that we liked because they were, you know, not problem children notes. But then there were notes that we were like, you know what, we don't even like this area. The people that we're servicing these notes on, like they're kind of a pain in the butt, and you know, we're getting code violations because of whatever. So it started to look like a risk. Like we can talk about the whole Joshua Tree incident for sure. We should talk about that.
Yeah.
But you know, we just decided in some areas we were going to exit all around, and meaning we're not going to go buy and sell there anymore, but we're also just not even going to hold the notes. So then we could free up $100,000 of, you know, what was on the balance sheet, and maybe we would take um, $60,000 to $80,000 for that. I mean, we were really lucky in that we were able to get 80 to 90 cents on the dollar for some of the notes. I don't think that's common, and we didn't do it a lot. You know, a lot of people like to buy these notes for 50 to 60 cents on the dollar, I think. But we were able to get like some good note sales, because I think people were just hungry when we were doing it at the time. But we were just able to free up a lot of capital at that point. And yeah, we took a discount. Maybe we had $100,000 worth of notes that we were selling. We took $70,000 for it, but we were then able to turn that capital back in, or push that capital back into areas that we liked better and deals that we liked better, you know?
Yeah, totally. And I mean, that was a really interesting time, I think, when we realized that there was a market for these notes. And one of the things that we learned that I think also shaped and influenced where we started to buy again was the value of the note is obviously directly correlated to the value of the underlying asset, right? So if it is a desirable property, if the market moves, if it's an established market, the note's going to hold more value, because that security, that collateral, if they do need to take, if they need to foreclose or forfeit on that property, and then they need to resell it, then they're going to have an easier time in doing that, right? And that's obvious, just basic risk analysis. But to me, we weren't considering that at all when we were originally going in. We were just doing deals to do deals. Anywhere that there was a deal to be done, we were doing that deal, and we didn't understand all of the associated risks with some of the markets that we went into, right? And maybe that's the segue into Joshua Tree, right? So let's hit on that real quick. Joshua Tree being a very established market, it's a beautiful place, obviously, and there's a lot of deal flow that occurs there. There's a lot of parcels, a lot of undeveloped parcels. There was this whole Airbnb craze that occurred, over a probably 3 to 5 year period, where all of a sudden we just saw prices in the area skyrocket, right? And I remember when we had acquired a bunch of properties there, and we started selling them really quickly, and we're like, oh man, this is great. And then we go back out to buy more properties, and I mean, people were screaming at us for our offers, because the secret got out, right? And everybody else started buying properties in that area, and they started paying more. But to jump into it, that being a really good established market, I think it is still a great market for certain things. It is still a great market for flips, for cash flips, for wholesale opportunities. For us, we didn't like the risk associated with owning it in our note portfolio. And that really came from one specific deal. And that may have been an outlier, but we just made the decision that it just wasn't a risk that we wanted to take. So to go a little deeper into the story here, we had sold a property to a gentleman, and we were still on title. And so as he had been making payments. He'd probably been making payments for about a year, a little over a year. And then we all of a sudden get this code violation notice, but it wasn't a normal code violation. It was from Game and Parks, and it also had some criminal liability attached to it. And so what had happened was Joshua trees are protected. And So you cannot, there are a lot of restrictions in what you can and cannot do on a property that has Joshua trees. And we didn't know this at the time, right? And so there's a very strict regulation that says that depending on the height of the Joshua tree and the age of the Joshua tree, you cannot build within a certain perimeter of that Joshua tree. And it's really to protect the root system of the Joshua tree, because they want to make sure that the Joshua tree is not going to be killed off by you building and digging down and damaging the root system. Well, this gentleman had not gone through the proper channels, did not get a permit, and he built a shed. And he built the shed literally right next to the Joshua tree. And so, we're dealing with the code enforcement division and game and parks. And I mean, they had literally sent us multiple notices saying that we were criminally liable for damaging this Joshua tree. And it was not just a little slap on the wrist. It was some serious issues that we had to deal with. And so, luckily, we were able to establish a really good relationship with the Game and Parks department, and we had to work with our legal team in order to kind of navigate through that. And we ended up taking a pretty significant loss on that property, right? And we worked through it, and thankfully nothing criminally came out of it for you and I. But that was our first exposure into, oh man, like this is a much bigger liability, a much bigger risk than what we had originally anticipated by selling a property to somebody else and then doing something illegally on the property. And it kind of opened our eyes to that. So I don't know if you want to elaborate on it anymore, but
Oh
that
man.
really, that shook us, and it took a lot of time and resources for us to work through that and make sure that uh, we were okay coming out at the other end, and then we just didn't want to deal with it again.
Yeah, I mean, I remember that was a big turning point for us because I was traveling around the world when this was going on. I was like, okay, we're getting a notice that this is not just a civil this is not going to be just a civil case, but they can pierce the corporate veil through our entity because we owned it in the LLC. It might have even been owned in a trust, I can't remember, but it was like it doesn't matter. If you own this property and there is this shed that's built next to this protected species, then we can come after you criminally. And I honestly I don't remember what it was. I think it referenced, you could have some time in jail plus an expensive fine or something like that. But regardless, it was like a criminal charge that you didn't want on your record and you didn't want to go to jail or pay a large fine. So it shook us for sure. But then I remember that there was the guy that was living in it. Like first of all, he moved onto the property in an RV, which was not legal, I don't believe anyway. So that was step number one. Then he built a shed. And I think that he did that before he kind of went off the deep end, but we were trying to reach him. He was originally corresponding back with us, and then he went silent. And then I think you probably reached out, or someone on our team reached out and got in touch with his sister or something like
Yeah,
that.
we got into, I think it was a relative of his. I don't remember who it was, but yeah, I mean, we went through great lengths to figure out a way to get in touch with this guy.
Yeah, and this is going to get funny, I think, for everybody listening. So this is how much we cared about this stuff. So this property, the thing I remember about it is we didn't take a loss as far as how much we put into the property and how much we got out of it, because we probably bought it back in, like, I don't know, who knows, 2018 or something like that for $1,000. But and maybe we had sold it once or twice and had a few forfeitures or something like that. It came back to us. I don't remember all the details, but what I do remember is I remember looking at it, and the guy that was living on it, he had paid us maybe $3,000 or $4,000. So we were certainly positive compared to what we had bought it for. But the promissory note, because the value had inflated so much in Joshua Tree from the time that we had originally bought it, it was like our basis was, call it $1,000 or $2,000, and the promissory note was $13,000 or $14,000. It had just skyrocketed out there. So this guy bought it for $13,000 or $14,000 on paper, and then had paid us maybe $3,000, $4,000. But he had gone silent, stopped paying, and apparently he was like on drugs. And so the thing that I remember is we cared so much about that, like 9 grand that was really like paper 9 grand that we were willing to do almost anything. And I had had a pretty nice scooter accident in Bali, and like I was really skinned up and like hardly able to walk. And I remember distinctly talking with you, and I don't know where I was going, but I was driving from San Diego and I was going to go east, and we were really seriously considering me going to this property and like having a word with this guy that was probably on drugs and probably going to shoot me. And I was fairly immobile anyway. And finally, I just remember we were talking about it. And I go, I don't care about this property. Like, let's just get rid of it. I'm not going to go out there and talk to this guy. This is insane. Not to mention, it was probably a 2 hour drive out of the way for me compared to where I was going. And so, yeah, we decided, we were like, you know what? Let's talk to the code violation officer and whoever else we were talking to. And we said, look, if we deed the property into this guy's name, are you guys cool with that? Can you go after him and not us? And that way you guys can, give him the notice. And they were super cool about it. They were like, you know what, we'll totally do that. We know it's not your guys' fault. This is just a weird situation. And that's what we did. I mean, we had the vesting instructions. That was one nice thing that we do when we get a property or when we sell a property, is we get them to sign the instructions on where they want the property vested. So we had that. And we just decided to say, okay, you know what? We're going to write off the rest of this note and just deed the property into this guy's name. And we did. And then we got formal notice, I think, where we got it signed by whatever the governing authority was. It was Game and Park or the code violation officer or whatever. But they were like, okay, you guys are officially off the hook.
Yeah, man, I remember getting that. And our legal team was like, hey, let's make sure that we get everything documented. And they signed the document that we had sent over releasing our liability, and we got that, and both kind of sighed this big sigh of relief. But back, I think another lesson or takeaway for us during that whole situation was we learned how important it is to be responsive and to actually communicate with these agencies, and they understand. And as long as you're on their side, the vast majority of the time they're going to work with you, and they're going to try and get the resolution, because that's ultimately what they want. They want resolution. And too often they deal with people that are totally unresponsive. And when you're non-responsive, then they're just going to continue to move forward with basically whatever the maximum is that they can enforce, because they're investing all of this time and energy. And so, man, I mean, I got pretty close with that enforcement officer, right? I mean, I was talking to him on a weekly basis and sending him email updates multiple times a week. And I think that really garnered a lot of good faith between us and them, where they were like, listen, we understand the full situation here, and we're going to work with you, and you're not just trying to circumvent this. And so, that is definitely a piece I would encourage people. Don't shy away from reaching out to any of these enforcement agencies whenever you're dealing with something, whether it's fire mitigation or code violations, or I mean, any of that stuff. Just be responsive, and they're going to work with you. And a lot of times we've negotiated things down or completely eliminated them, right? Because we've just been responsive.
Communication is key for
Yeah.
sure.
Yeah.
Yeah. You brought up something earlier, and I wanted to circle back to this, and it's a total vanity metric, but it's like, doing several thousand deals. And I know when we were really counting the deals that we were doing and everything, we had gotten somewhere north of 2,000 deals over a 10-year period. And it sounds super impressive, but I think it was one of our biggest mistakes, because we were so focused on doing low dollar deals at a high volume. And that created so many problems for us, really. Like, we then had this big note portfolio, which, again, impressive to have a note portfolio of a certain size. But what the kind of like the second order effects of that were code violations coming in, so we're getting code violations from all these different states and counties, and really just counties, I guess. But we're getting code violations, and then we're getting property taxes and HOA bills. And it's like, managing that was insane, you
Oh yeah.
know?
Yeah, we built a whole team around that. I mean, we built a whole company around that, right?
Yeah.
it became a whole separate business.
Yeah, yeah. So just trying to get to that number, or reverse engineering and saying, oh, you know what, these guys did a lot of deals. It's like a total vanity metric. I think looking back, and we eventually made this decision to step into larger deals. But I mean, the question for you is, and I think I know my answer, but would you have gone into bigger deals sooner? And let's, to define it, we were doing a lot of deals where our average purchase price was between $2,000 and $4,000, and we were really trying to get a 3 to 4x on that when we would sell it. 3x if we were selling for cash, and then 4x if we were selling on terms. And that was great, and it did work. But I feel like we should have just slowed that way down at some point and kept it going. And while we still do that on a much smaller scale to keep the note portfolio alive and create some stability, like I feel like there was a point where we should have just cut it off, and or not cut it off, but like slowed it way down and just kept the note portfolio at a certain size and then migrated to those larger deals. And we did that later, but like I don't know, man, like I feel like I would have done that way sooner in hindsight.
Yeah, I think so too. But I think we've learned some lessons from both ends of that, right? Where, I mean, we were doing some deals where we would buy it for $100 and sell it for $1,000, right? And we're sitting there like, oh, what a great ROI. Like, let's go do a bunch of those. And then what we didn't factor into the consideration there is all of the work that goes into the deal to make $900, right? I mean, forget the ROI. We're looking at a $900 really profit on deal, right? And that was a metric that we tracked very close. We still track very closely, is profit on deal. But once we started looking at that, it's like, oh man, we're losing money on these deals. I mean, with our marketing effort to get the deal, with our overhead and OpEx and everything else that's going to go into this, we're losing money. So it doesn't matter what that ROI is. So then, going to the other end of the spectrum, if you're doing these bigger deals, then the market gets more efficient, right? And it's a different business. And so as the market gets more efficient, people are more accustomed to working with real estate agents. They're more accustomed to working with third-party title and escrow companies. And so you have to shift your business model a little bit. And the returns from the ROI perspective, that typically, unless you find some home run deal, that gets compressed, but the dollars are still there, right? And they're much more significant. I mean, you're not doing a $50,000 deal and selling it for 50,900, right? Like
Yeah.
that's not a deal that you chase. But to go back to your question, I agree. I think what I wish we would have done is kind of diversified the the I wish we would have diversified where we were targeting properties and the different price bands that we were targeting. And I do think that there are sweet spots for different models at each price band. And we learn that over time, right? So there is a really good sweet spot for some of these sub $20,000 properties to be able to both sell on terms and to be able to sell for cash really quickly, because that amount of cash is it's not substantial, and there's a pretty big buyer pool for that. And then there's a different buyer pool and a different marketing, a different strategy for properties that are maybe between 25 and 50,000. And then there's a whole different strategy for properties that are 50 to 100. And then as you get up above 100, that was kind of where we drew the line from, like those were the bigger deals, right? So $100 grand, either, through the acquisition or your resale price. That's just a different market, a different clientele, a different property, product, all of those things. And you need to develop all of the assets that accompany that, right? So your marketing needs to change. Your audience is very different. And so the way that you speak to that audience is very different. And so I kind of went off on a tangent there, but my short answer again is yes, I wish we would have diversified and looked at expanding to some of these other price bands much quicker than we did.
Yeah, yeah. And I don't think there's any right answer there. Part of it's personal preference, part of it's just where you are and what you can afford. A lot of it too is just, potentially looking at it from a risk standpoint. When you're doing these deals where you're buying them for a couple $1,000 and selling them for 3 to 4x that, the level of underwriting that you have to do there is maybe not as much as you do where you're going to go out and buy a property that's worth $200,000, and you might really want to get a soil study. You might want to make sure that the slope is totally suitable for building a house on that, and you might also want to get a survey, right? There's just certain things that you're going to want to do on that front end where you might spend $1,000 on due diligence for one of those properties, but it's totally worth it because you might, you know, save yourself from $100,000 mistake. Whereas the smaller deals, some of those things just don't matter. I mean, we never got a perk test or any sort of soil study on deals that were sub 20,000 ever.
Right. Right.
Maybe once. I think someone wanted us to get one, but we had already bought it, so wasn't even part of our due diligence.
Yeah, I don't remember.
Yeah. So anyway, so yeah, you're right. And then on the back end, the channels that you're using to sell the properties, for the lower value stuff, we're marketing it on land.com and land flip and land search. And then we're selling it directly through our website. And people are buying it through our website, going through a checkout process. Like that's a totally different channel than, a larger property. We're not going to have someone check out on our website for a property that's worth $100,000, $200,000. That's getting marketed primarily through realtors. And
Yeah.
that's what's expected at that price point.
Yep.
So moving to bigger deals or diversifying sooner, I think is a lesson that we could look back on and just be like, okay, we should have started to add these in. But I will say it was tough because to get the team that we had existing to do those deals didn't work. Like looking back, it would have made a lot more sense to just hire a completely different team, a very small team, and go, you don't even know about this business model here with the smaller deals and the seller financing and everything that goes along with that. That just, you're not going to get any exposure to that. You're over here and you're going to do bigger deals. We just buy for cash, list it with the realtor, and sell it.
Yep. Yeah, I totally agree. That's a really good point. Man, lots of lessons here.
Yeah, I mean, I think the biggest thing is, getting the road to like $1 million is sort of, it's in our journey. We don't even know when that actually hit. I'm sure we could go back through all the QuickBooks and see, when we hit $1 million. I would guess we probably hit $1 million balance sheet sometime in year 2 or 3, and that was cool and exciting, and it wasn't paying the bills, but it was cool and exciting. And eventually, probably, I don't know, a couple years after that, really, probably year 4 or 5, we really crossed like the $1 million revenue mark in 1 year. Is
Yeah.
my guess.
Yeah, I was gonna say I think that's probably right. And then hitting that $1 million profit on deal, was probably pretty close to that as well, right? Where we were able to look back and say, okay, like that's a pretty cool milestone. And then why did we even really focus on a couple of those other metrics before? Because this is really what matters. This is what we are striving to achieve.
Yeah. Well, I was laughing because we didn't even look at profit on deal until year 6 or 7 when we started to really say, oh, cash flips. Let's start actually like focusing on some cash flips. Let's try to sell, some of our properties, even on the lower end of the value spectrum, for cash. And then, but it really came into play when we started doing the larger cash flips. We were trying to say, we were trying to move up the food chain, and we were trying to say, okay, we bought this property for 30 and we sold it for 60, and there were, $6,000 of fees associated with it. And because we typically land around, 9 to 12% of cost on these deals. So our actual profit on the deal was the 60 minus the 6 minus the 30. And so that's where we really started to track that. But it's like we didn't even track it for the first 6 years. It almost didn't matter because we were so focused on building a note portfolio.
Yeah. Yeah.
Anyway, lots of pain, lots of good lessons. What else, man, on the road to 1 million, or could we talk about here?
Oh man, I feel like there's a million lessons that are going to come out of future episodes here. Um, but I think we hit most of like the big details here. I think to kind of sum up, you know, a lot of people get hung up again on these vanity metrics. We've kind of harped on that a little bit, right? But for for you, every case is going to be different. Every scenario is going to be different. Every circumstance, people are at different points in their lives, and there is no right answer here into what the best approach or strategy is going to be for everybody. It has to be uniquely for you. And so, I think we got a lot of whiplash, right, between some of the mentors that we've had who are incredibly successful and have done some really impressive things. And it was like, hey, you should really focus on this. And so then we just blindly diverted all of our attention to that. And then we got pulled back by somebody else or some other clip of advice. And it's like, oh man, we're doing this all wrong. We're going to do it. The pendulum's going to swing all the way to the other side, and we're going to just focus on that. And really, it's important to take a step back and take the advice, take whatever guidance or insights that you can, but really reflect and apply them to your situation and what feels right for you and where you're at. You may be at a position where you say, I don't need to do any cash flips at all. I just want to build up a note portfolio. And that could be the best thing for you. And you have the ability to do that. Or your timeline could be totally different. You could love your day job and you just want to build up this passive income on the side. And that's a great strategy. It's a great way to go. But it really depends on what your goals are. So, take everything we say, obviously, with a grain of salt,
Yes.
knowing that was what worked for us or what lessons we've learned from the mistakes we've made. But yeah, it just do what's right for you. Trust your gut. We're gonna probably say that all the time too.
Yeah, but know where you are and know where you're trying to go. No, don't look around at everybody else and think that you have to do what they're doing to be successful or maybe what they did. And I mean, hopefully this is a nice episode where you're looking back in the past or looking at our mistakes and saying, okay, like there's these guys made a lot of mistakes based on where they were and where they were trying to go. And, maybe there's some similarities to where you are right now and where you're trying to go. And you can learn from that and shortcut it. So I think that's the key thing is it's just situational awareness.
Totally. And it's gonna shift all the time, right? I mean, there are different things that you can do and different options, different paths that you can take. You could go to deal funders to find additional capital. You could borrow money. You could leverage some other assets that you have to free up cash. I mean, there's so many different scenarios that you could go down, but I do think that guiding light, like you just said, know where you are, know where you want to go, and make sure that the decisions you're making are really pushing you in that direction. That'll help get you where you want to go pretty quickly.
Right on, man. I'd say we wrap it there.
Yeah, rock and roll.